Good afternoon. I'm Aaron Klein, a fellow at the Brookings Institution and policy director for our Center on Markets and Regulation. It gives me great pleasure to welcome Brian Brooks, the Acting Comptroller of the Currency. Mr. Brooks became the Acting Comptroller of the Office of the Comptroller of the Currency, which supervises nearly 1,200 national banks, federal savings associations, and agencies of foreign banks. Together, they constitute approximately 70% of all banking business in the United States. In addition to serving as comptroller, he's also a director of the FDIC, a member of the Financial Stability Oversight Council, and the Federal Financial Institutions Examination Council. So as you can see, Brian is deeply enmeshed in financial regulation on a variety of platforms. Prior to becoming Acting Comptroller, he was Senior Deputy Comptroller and Chief Operating Officer. Prior to joining the OCC, Brian has a long and distinguished history. He was Chief Legal Officer at Coinbase. He was Executive Vice President and General Counsel at Fannie Mae. He served as Vice Chairman of One West. He was Managing Partner of O'Malveny and Myers. We can go on and on all the way back to his law degree from the University of Chicago, a wonderful institution where I'm proud to say my mother was one of the first female graduates. But we're here, Brian, to talk about your ideas and proposal to fix the nation's payment system. And I encourage the audience to engage on Twitter with the hashtag #FixPayments. It is insane to me that I can go on my TV and stream any amount of content in the universe and have it immediately accessible. I can go onto my phone and deposit a check or a payment instrument. But when it comes to actually getting that money that I can use, it is a multi-day wait. And that wait, as we've been documenting for years, is devastating for the half of Americans who live paycheck to paycheck or constantly live on the edge. One might think that if technology can move getting a DVD from Blockbuster to Netflix, we ought to be able to get payments moving around America immediately like they do the rest of the world. So Brian, what are your thoughts about how we can fix this payment system, and what are your thoughts about the implications of our failure to fix this payment system on American consumers, the economy, and particularly underserved communities? So with that, Brian, what do you think?
Well, Aaron, listen, as always, when you and I get together, I couldn't put it better or more emphatically than you just did. So I'll try in my own way here. But let me just tell you, when I worked at Coinbase, we used to have a line that we said all the time, Coinbase being a big blockchain platform. We used to say that the fastest way to get money to Australia is to put it in a suitcase and get on an airplane. There's no other way to get it faster out of the United States than just to physically take it out of the country. And that's a crazy way to run a railroad. So let me just begin by saying that we've been thinking a lot about payments at the OCC for some time now. And the biggest reason we're really focused on payments has less to do with individual consumers and more to do with the stability of the system, right? So here in this country, most payments activity is still done inside the banking system, and most of that's inside the national banking system, which we regulate. But in the last 10 years, we've seen increasingly much payments activity bleed out of the banking system as part of what I call the great unbundling of banking. The component parts of banking turn out to do a little bit better. The customer experience is a little bit better. The profitability is a little bit better if you do it on a specialty basis than if you do it on a bundled basis. And that's why we now have Stripe and Square and PayPal capturing so much market share that used to be done by Bank of America and JP Morgan. So the system, I think, demands that there be a single place where supervision can occur, and the only place that can be is the National Bank Charter. Having said that, there are all kinds of more radical innovations that we have to unlock, I think, if America is going to remain a competitive market economy. And those have to do with all the things you're talking about. So I'll just take two of them, if I could. One has to do with the speed to payment. So we already have a real-time payment system in the UK, in China, which you've written about, and a number of other places. And somehow in the United States, the best we can promise is that maybe we'll have a faster payment system in 2024. Now, when the government promises 2024, that usually means 2030 or possibly never. But best case scenario, we will only be 10 years behind the UK. That's unacceptable. We know that there are ways of making this go faster. And whether you believe that way is the deployment of private sector built blockchains, or whether you believe it's following the UK model and having a more open system where banks and non-banks connect to the payment rails on an equal basis, whatever that is, we know there's a way of doing it better. And as you say, it does directly affect consumers, and particularly paycheck to paycheck consumers, right? Who are most affected by, on the front end, slow funds availability rules, and on the back end, slow payment transmission, right? Which results in them both receiving the dollars they've earned more slowly than they probably need to, and paying late fees and being 31 days in default more often than they should be. All of those things can be solved if we have a platform that unlocks innovation more quickly than this command and control environment we work in. So amen to everything you said.
So I agree with you. In fact, the only area where I disagree with you that is we actually do have a real-time payment network built and operated by the clearinghouse, and one we could have chosen to use, right? And some of your institutions are choosing to use it more and more every day. Some are not, whether or not the Fed can get there before my rising fifth grader graduates high school to be determined. But this cost of delay I've calculated is over $100 billion for low-income consumers, including bank overdraft fees, payday loans, and check cashers. There are a small group of banks making a fortune on overdraft fee. In fact, I have forthcoming research that'll show that it's more than 50% of profits for 7 banks in America, which makes me wonder, are these banks, are they check cashers with a charter? But let me ask you on the question of a charter, Brian. What is your proposed solution from the comptroller's perspective? You don't have control of the Expedited Funds Availability Act like the Federal Reserve does, that could snap their fingers and make the money available faster. Query whether or not you think making money available faster would make a huge impact for people, particularly on these stimulus checks. But what are you thinking of doing in your seat with your authority, given this unbundling of banking services, in terms of changing policy? What's on your agenda?
Yeah, well, so Aaron, this is something I think about every day. And the basic concept is this. So if you start with the unbundling point we just talked about, payments is a core banking function. I mean, if you think about it, for those of your listeners who are relatively new to this space, banking historically consists of an amalgam of 3 or 4 different activities, the principal ones being historically deposit taking, lending, and payments. So most payments activity happens inside the banking system. And as I said a moment ago, that has only started to shift radically in the last 5 years or so, when these specialty companies that are doing only payments processing have captured enormous market share away from the banks. So we have the following view, and it's really based on 2 pillars. One of them is that it's a good thing for substantial financial intermediation activity to be supervised than unsupervised. We think that's kind of obvious, but maybe not that obvious. And so, the OCC is the only agency that provides comprehensive nationwide supervision of institutions. There's no other organization that does that in the banking system. And given that payments is one of the core banking functions, we don't want it to leave the supervisory field of vision. We want to be able to continue to ensure the safety and soundness of the system without letting the core activities bleed into the shadow banking system where it has now gone. I think we all learned the lesson in 2006 and 2007 of why shadow banking, it's still banking, but it's not supervised, at least not supervised in the same way. So I start with that. And then the second point of all of this is payments, probably more than any other financial activity, is inherently borderless. Think about it this way. Lending, you could argue, is something that can be done on a state-by-state basis if you wanted to do. There are plenty of local credit unions, small banks, and others that gather their deposits inside of one state, only lend to customers in one state. You could argue that the idea of state-based regulation of lenders is somewhat sensible. But when it comes to payments, payments really are inherently borderless. I mean, very few of us are making our mortgage payments or our credit card payments to a bank that resides in our city, and often the servicer is in yet a different state from the lender and from us. These things do not respect borders. And thus the system we have today requires any given payment company to obtain 51 money transmission licenses to do their business. I don't think anybody, not even a state regulator, if they were sitting ex ante, would purposely design the system that way. Now, I do understand that all of us are looking to protect our territory and our authority and our jurisdiction. So I get that we all have our roles to play in the ecosystem. But nobody would purposely say, yes, it's important that Visa be licensed separately in both Nebraska and New Hampshire, right? Or that Stripe have to talk to the Florida Department of Banking and the California Department of Business Oversight in order to transmit payments from one place to another. Nobody would believe that if they were looking at it ex ante. And so we're trying to solve both of those problems, create a national platform, right? And keep core banking services inside of the supervisory field of vision. That's really what it's about.
So on that, then is it fair to argue that the failure to modernize our payments platform within the banking system pushes up pressure to move payments outside of banking, right? There's a reason I use PayPal to move money around with my friends, right? It's faster. There's a reason these other companies have come in to intermediate. But there's also, so one, it sounds like that's a real consequence of the failure to modernize the system. Two, Congress has never created a national money transmission license. Congress created the Comptroller of the Currency's Office, not because they believed in the value of national banking, right? It was to the contrary. They rejected national banking a couple times. But state-based banking didn't work very well during the Civil War when some of the states tried to leave. And so you had to have a national bank, right? Lincoln is the one who creates the Comptroller's Office. Absent a national crisis, why do you think Congress hasn't put up a national money transmission license? And why is your solution better in the absence of congressional action?
Well, let me say two things about that, Aaron. So first of all, I'll give you a provocative soundbite here, which is I actually think that Congress did create a national money transmission license. It's called the National Bank Charter. The reason I say that is the vast majority of money transmission happens inside of companies that we all recognize as banks. So my point about unbundling is all these money transmitters is they're doing an activity that used to be done exclusively inside of banking, except they're doing it on a state platform, and the only thing states have to offer them is a money transmission license. But the activity is not different. Whether you think of it as prepaid cards or traveler's checks or electronic money transmission, all of those things can be done in one of two places, either a state money transmitter or a national bank, right? So I would argue that we already have a national license called the Bank Charter. So I kind of begin with that. The second thing I tell you is on the history lesson, it's kind of interesting. So you may know I recently hired a new chief economist here who's a very famous financial historian from Columbia. And he spent some time in the last couple of weeks reminding me of the real history of this place, right? So this place that I'm working in right now wasn't created by the National Bank Act of 1864. It was created by the National Currency Act of 1863. And the original vision of the Comptroller's Office, and the reason my job is called Comptroller of the Currency, not like Comptroller of Banking, is because initially the idea was to create a single system of competitive payments, right? That was the whole idea, is we would have a national bank system of competitive institutions where the Congress at the time was rejecting both the original Bank of the United States model, but also the system of state banking that had preceded the National Currency Act. And so here the idea was everybody was going to issue something called dollars, but they would do it on a competitive basis based on their ability to buy treasuries and hold them. So I come back to the idea of the core function of the OCC originally was actually payments.
Fascinating. That's really, really interesting. Since I love provocative sound bites at Brookings Institution events, let's go with this unbundling concept. We had a question, and the audience can tweet us questions at Fixed Payments or email at events.brookings.edu. But we had a question come in before the event from the great Jonah Crane, who asked your views on the separation of banking and commerce. Because my view of the read of the law, right? We have this big separation of banking and commerce. It's a fundamental pillar in the U.S. But when you really dive down to it, banking is about the taking of deposits and the making of loans. The provision of payment services, which you correctly point out, has been part of the banking system for a very long time because banks had a comparative advantage doing it. Not because it was legally precluded in this box of banking, not this box of commerce. In fact, you can do a bunch of payments operation and not be a bank. And you can be a bank and do payments and not be a commercial entity. So this unbundling really tests this. On the theoretical or philosophical level, do you agree with the separation of banking and commerce?
Well, I'm going to go back to your premise, so I'll answer your question, but let me go back to your premise, which is banking consists of the taking of deposits and the making of loans. In the 50s, people used to believe that. So, and I've never thought of you as a 50s kind of a guy, but just look at your haircut. Come on, Aaron. I mean, this is the 2020s. I think what banking is really about, and what I'm trying to kind of get us to reimagine, is it's about financial intermediation writ large. So when did we first learn this? We first really learned this in the 70s and 80s when the global capital markets really became a significant substitute for bank lending as it had previously existed. And if you remember the famous 1982 Jerry Corrigan article about what makes banks special, he sort of tries to take down the notion that what makes them special is that they take deposits and make loans. His point then was, actually, there are now lots of substitutes for deposits and lots of substitutes for loans. So a person who's looking for a safe place to keep their money can invest in government bonds or in corporate bonds. And a person who
money market mutual funds, since we guarantee them in every crisis.
Exactly. So well put. And on the lending side, it turns out that any corporate borrower who wants to access lending can come to the bank for a loan, or they can just issue debentures and bonds on the market. And those are just different ways of accessing capital. So I think at the end of the day, if the only thing that defines banking is taking deposits and making loans, banks eventually are going to go away as we know them. And so that gets to my point. We need to rethink it in terms of what the actual statutes talk about, which is banks have a whole lot of powers, not just deposits and lending, and not necessarily all of those together. So I start with that proposition. Then I turn to the proposition of, in the 70s and 80s, there were all of these cases testing what banks' powers were. So these were the cases that held that banks, when they first started to computerize and do bank transactions, over computer networks, it was held that banks could sell their excess data processing capacity as a for-profit business, even to people who weren't their banking customers. And that was thought to be a permissible business of banking activity. Then there was the question of, well, could banks provide travel agency services for their customers, or could they run rental car agencies? And in case after case, the DC Circuit, the Supreme Court said, yes, banks can do all of those things because they're all related to their business of financial intermediation. So what I think is the question of business of banking and commerce is very much like these old debates of banking versus investment banking or banking versus securities. Those previously almost religiously held distinctions, they all fell away in the light of economic demand. In the end of the day, people are choosing to receive their financial services however they're choosing to receive them. And the bank charter has to be sufficiently flexible to be relevant to the generation that's trying to receive those financial services. And so, coming to this commerce idea, at the end of the day, it's not really clear that business, which generates income, invests income, takes risks and engages in various, intermediation activities, is all that different from certain aspects of banking. So like, I'm not telling you that I think Walmart should get a charter or shouldn't get a charter, but I think a lot of those old walls have started to come down because of economic reality. In the end of the day, it's customer demand that determines how we receive services. It's not these magic walls that got enacted in some historical moment.
Well, I can tell you from my research, one of the biggest overdraft giants in America is a bank whose basic business model is branching inside of Walmart. Let me ask you a different question, kind of building on this, which is, you mentioned the legal foundation, and I was tying the taking of banking, the deposits and loans, as a legal construct. Your predecessor came out with a fintech charter and was sued, and that case is working its way through the courts. You come from a legal background. How confident are you in the legality of this proposal?
I'm highly confident. Look, the great thing about being a litigator by training is when someone says, I'm going to sue you, it doesn't really scare you all that much. I mean, I litigated cases for a living, and sometimes it took me going all the way to the Supreme Court before I finally won. But that's why we have 3 tiers of courts in America, and it's why we have 93 different judicial districts. The view of one district judge is never the on any important subject. And, the way cases get to the Supreme Court is you have a bunch of different district judges coming to different outcomes. What I think about the case is, I think that, that was a case involving particular issues in front of a particular judge, argued a particular way. But my read of the law is that for more than 25 years, OCC regulations have said that a bank is anything that takes deposits, make loans, or engages in payments, or, right, has been in our reg for ever since I graduated from law school. And I know that the OCC historically has been given deference by the US Supreme Court in its definition of what proper bank activities are. So it would be truly radical to hold that the OCC's interpretation of what a bank is didn't prevail. I don't actually believe there's ever been a case in the US Supreme Court where the OCC did not win on that point, and there are more than a dozen cases where it did win. So I'm highly confident in the outcome. Doesn't mean there won't be twists and turns. You know, we'll win some and lose some probably along the way to the Supreme Court, but as I like to tell my friends, I've lost more votes in the Supreme Court than most people have ever asked for. So we'll see.
That sounds good. Well, let me see this in as these twists and turns. You just got a letter today from all the bank and credit union major trades, and it was on this very topic. And as I read the letter, it kind of asked for two things. One, that you guys have an open and transparent process. So I'm going to ask you whether you will commit to an open and transparent process. And the second question has to do with whether or not under this new payments charter you're thinking about, it would trigger bank holding company action. And on this one, I think is a little more, the nuances here are a little more interesting because number one, any payment charter that you grant still needs a master account from the Federal Reserve to be able to access the Fed's payment system. As Peter Conti Brown, one of the leading payment scholars in America, has written, the Fed does not have any legal authority to make decisions on the basis of granting charters. It's simply they shall grant. Yet in recent case after case in Colorado with Four Corners Credit Union, in New York with the Narrow Bank, the Fed has refused charter applications that seem to meet all of their statutory criteria. Peter's argued they're inventing a discretionary authority. In addition, much of the criticism that I and others have launched to the Fed's failure to modernize their payment system is this weird role of regulating the payment system and operating their own ACH system, and their inability to promulgate regulations required by law that their own outdated system could. One could imagine if VHS was in charge of data standardization for streaming, we may not have gotten there. So let me ask you to respond to this trades letter's questions on these 2 points: transparency and openness of process, and two, whether or not this charter will trigger Bank Holding Company Act authority for the Fed.
Yeah, well, so Aaron, these are great questions. Obviously, we just got this letter today, and we'll respond in the fullness of time. It's a long letter with a lot of analysis written by a lot of smart people, so it deserves a full response, which we'll provide. On those particular topics, though, I'll just tell you my top line answer, which is there will be no less transparency process here than there is with respect to the bank charter I signed this morning. I mean, this is what we do here: is we grant bank charters. We review applications pursuant to a set of rules, and when the banks meet the rules, we grant the charter. So I don't think there's any kind of a lack of transparency here. I think what may be confusing to people on the transparency front is the way the concept of a non-depository fintech charter first got launched under Comptroller Curry's tenure was a little bit different from how I think of it. There was this concept at the time of, what people refer to as the special purpose charter, like it was really a new charter. I don't personally believe, with all due respect, that that's the right way to think about it. If we take our own regulations seriously, which say a national bank is anything that does one of those three things I mentioned, this is not a special purpose charter at all. It's a bank. It's just a bank. And so in the same sense that, sometimes we grant charters to banks that are focused on technology lending, and sometimes we're focused on credit card banks, and sometimes we're focused on banks that have a heavy emphasis on real estate. We don't have like a real estate bank, and we don't have like a derivatives bank, we just have banks. That's what we have. We really have two kinds of things. We have banks and trust banks. That accounts for 95% of what we've got going along here if you include thrifts within the concept of a bank. So the way I'm envisioning this is, if you're a company that does a qualifying activities or primary activity, then you get to be a bank, period. Not a special purpose bank, a bank with all of the things that come with that. That includes, by the way, capital rules. It includes BSA compliance. It includes, all of the other things. It includes a sort of community to reinvestment like requirements for financial inclusion. So I think where perhaps we get off track with the trade groups that wrote us today is they're still thinking about the 5 years ago concept of a fintech charter. We're not really talking about a new charter. We're talking about the idea that you're eligible for a bank charter if you do payments, even if you don't do deposits. And that runs into the New York case we recognize, but we think that case is wrong, to be honest. That's why we're appealing it. So think about it like that, as a full-on bank charter for somebody whose focus is payments. If you think about it like this, Aaron, imagine that we had a bank today that was engaged in deposit taking and lending and payments. And imagine that bank decided to get out of the payments business. So now it's only doing 2 of the 3 factors. Would we think that somehow that bank had to give up its charter? I don't think so. I think it's a bank and it gets to choose over time what its business plan is. And so I think it's as simple as that. On the Bank Holding Company Act part, I think there's an actual answer to that. The Bank Holding Company Act says you're not a bank holding company if you don't own an insured depository institution. And if a company came in, like let's say if PayPal applied for a charter on the theory that they do payments, as a matter of law, they will not trigger the Bank Holding Company Act because they don't take insured deposits. Now, Congress could choose to change that if they wanted to, but I would question why they would want to. More command and control regulation, I don't think, is necessarily consistent with at least this administration's worldview of letting markets rather than regulators decide how consumers receive their services. But I think the misunderstanding that these trade groups are operating under is the idea that somehow this is going to be a lighter touch charter with fewer obligations and it's going to make the playing field unlevel. I think it's just the opposite. I think what they're watching right now is some of their best businesses are migrating out of the system where they'd have much lighter obligations. I want to bring those things back into the system. And so if you believe in level playing field, I'm your best friend.
So thank you. We're going towards the end of the conversation. So you mentioned this administration, and I'd be remiss if I didn't mention the president said, at least according to Secretary Mnuchin, that he wants the next round of COVID stimulus checks to get to people as quickly as possible. Yesterday, Vice President Biden called on real-time payments as part of his platform to address inequality. The last set of payments, the Treasury Department gave the instruction the money was coming to and how much to each bank on Good Friday. This was in the first round of direct deposits, the fastest people got money. And it didn't show up available into people's accounts until Wednesday. If you were in charge, or you the president or the Secretary of Treasury was going to ask you, should we make these funds immediately available to people? Should the Expedited Funds Availability Act? It's not in your jurisdiction. It's not in your control, but it says that you can sit on Treasury funds for a little while. Both checks from the Treasury Department, which millions of people, tens of millions of people got months later, as well as governing some of the time availability on direct deposits. Congress can change that law. It would seem to satisfy the president's objective. Do you think it would be a good thing for America and for the banking system for people to get their next round of stimulus faster?
Yeah, no question, Aaron. No question. I mean, if I had a voice on this, and my voice here is just the same as yours or anybody else's, but as a citizen, absolutely. As a regulator, the question is, how do you do that? And the answer is, we don't have a Fed. Fed now does not yet exist except on paper. There is, as you say, the ACH upgrade that would allow something faster. That would be a good thing. There are also existing private sector blockchain technologies on smart contracts where one could simply program the stuff and hit the automate button and it would instantly appear to everybody who's connected on that network. Technology is the answer here. We have been slower than any other major country to embrace technology. We, unfortunately, are the victim of our own success 100 years ago. 100 years ago, we had the most advanced financial system in the world, and we still have the most advanced financial system circa 1910. That's our problem, is we're building on top of old rails and old systems. We need to just start over, and that's what I'm trying to embrace here.
Well, we appreciate your new thinking. Some banks did make the money available on Good Friday. They all could have, they all should have. Congress can require that in this new law. I'm glad to hear that you add your voice to the echo chamber of people that think that would be a good idea. And I really want to thank you for your time and thoughts on this. I want to close by asking you, if you look back at the end of your tenure as comptroller of the currency, and you're able to accomplish your goal in payments, what does that look like?
I think if I had a 5-year term as controller, I think it looks like two things. One is there is a national platform for payments companies out there that don't have to deal with patchwork state laws and all of that. Okay, that's the first thing. That brings everything into the supervisory framework. And the second thing we didn't talk that much about is I'm a believer in decentralization. I think at the end of the day, I think that stable coins and other kind of blockchain-based tokenization of dollars are the most resilient model, for long-term faster payments, better than a central bank monopoly on the payment system. And, nodes on networks tend to be much more fail-safe and resilient than centralized administration. So those two things, I think, would be a big success.
Well, we would be happy and thrilled to bring you back to talk about central bank digital currency, digital dollar, all these terms that are frequently chatted about in the think tank world, and I think require deep, keen minds with actual practical experience, of which, Brian, you're top of the list. And I want to thank you very much for sharing a little bit of your afternoon and your wisdom with us.
Real pleasure, Aaron. Thanks for doing this.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.